We have Jason Ambrose, CEO of Vanda-Securities, joining Nick and myself right here around the tables. Jason, very nice to see you. Thank you very much for coming in.
Thanks for having me.
So, SNB move, does this mean that all the ducks are in order for the ECB to launch a big bazooka?
Well, as you know, Chloe, I mean, we're a strategy firm and we specialize in positioning, so we always tend to focus from that angle to start with to see where investors, where the sort of critical points of investor sentiment lies. So I think for us, it's more a case of when you have a surprise move like the Swiss National Bank yesterday, it's more the unintended consequences that we will focus on. So whilst it's a surprise in terms of its timing, it's more, where could the problems lie? And the problems, as far as I'm concerned, where they lie are when you have an environment that you've seen in the world over the course of, certainly for the last couple of years, where the central banks are forcing you to go look for carry, and they're forcing you up the risk curve to go look for carry, and forcing you up a risk curve that you don't really want to take at many times. What that leads markets, and what that leads some big market players to do, because we're in the world of year-on-year returns nowadays, is it forces participants into trades they wouldn't normally do. And when I say they wouldn't normally do it, it forces them to sell volatility. It forces them to put on trades that they think, like a Euro-Swiss peg, might last, and that the central bank might indeed hold its position because they were told a few weeks ago that they would. Right. So for me, I'm more interested in what does that mean to markets in general, and what does that also mean to investors. And you know, when we look at positioning now, the market has been very, very heavily positioned. And when I say very heavily positioned, it's 3 or 4 year highs in big assets like US Treasuries. Now, US Treasuries, and particularly at the longer end, around the sort of 10-year end, they're the central points for risk. All risk is measured from US 10s, because US 10s are the pivotal point of they get risk right. Yeah,
but why are the U.S. 10-year yield at the point when there was that flash crash of October, when supposedly the wall of easy money is back in the world?
Well, I think we're close to the point of another flash crash. Why I say that, it's not just so much that people are so short the 10-year Treasury expecting yields to go higher, but any trade that's also correlated to that is also very crowded. So the market is expecting a severe steepening of the yield curve in the US because they're expecting better times. They've seen some really quite decent, certainly if you look at it on a quarter-on-quarter basis, you've seen some really quite decent economic data out of the US. Things were really starting to turn. And the market was in this perception that it was only exogenous factors that was keeping US yields lower. And we could say that those exogenous factors are disinflation. We could say that would be Greece or Europe or Russia. And Russia, I think, by the way, is a very big risk. So the market was caught. It was thinking, well, yields are going up because a lot of these factors that were around, the ECB is going to print, Russia's going to go away, Greece will fly through. Then we can go back to this normal scenario that we normally see, where economic surprises and US 10-year rates correlate. Therefore, the world can go back onto risk. And I think what you've seen happen with the Swiss National Bank, it's brought a lot of skeletons out of the cupboard in terms of unintended consequences. And that's what we now need to worry about. What else is unintended out there?
Another factor as well is that as yields fall, you'll have natural buyers of treasuries as well. So pension funds and insurance companies that have to buy them because their liabilities are shifting as a result of the fall in yields.
Whilst we're going into, I think, a very dangerous period up until that point, when we get to the point where we actually have that button pressed, and whether it's a 500 number or I think Nick was talking about a billion number, I think that's almost irrelevant. I think what's relevant is the action has taken place because there's so much skepticism around Europe and how it implements its policy. When you have a switch, and people like us as a strategy firm think that that's the low point in the yield cycle, when you have that switch, that's really meaningful for positioning. So I'd be very careful with these high-yielding equities that look really quite attractive at this point in time. That can change very quickly. They're extremely crowded.
Yeah, a lot of people got burned by the SNB move, and certainly as we head into 2 big headline events, I think there will be more surprises, upsets on the way as well.